This is InvestTalk. Independent thinking, shared success.
Robert from Pleasanton looking at First Solar FSLR.
Yes, hi, Justin. I'm looking at this. I don't currently own it, but it has come down quite a bit. And I'm just wondering if you think there's some value to be had here now.
Well, obviously, the new administration is not very friendly to the solar industry. Right? They're focusing on drill baby drill, maybe nuclear, but when it comes to green energy, solar really isn't in their wheelhouse something that they are going to support. And if they're trying to cut spending and subsidies, this is in their crosshairs, clearly. And I think that is what you have to watch out for. And this peaked back in June of last year at around $300 per share. Now we're down to 136. And the technicals are just too poor for me to get excited about it. And I haven't seen a real spike in volatility that tells me capitulation is in. And so that's my issue. And now the good thing here is that of the solar names, First Solar is historically one of the best run, most profitable, most consistent businesses. However, free cash flow now on this name has been negative really since the pandemic and beyond, and it continues to be very negative. And now they have a good balance sheet. That's a positive. Not a lot of debt. That's good. So it's hard to go bankrupt when you don't have a lot of debt. The issue is that they've been continuously issuing shares each year, diluting shareholders. And so I don't think if you look at earnings, they look pretty cheap, but I don't think that's very good earnings quality, to be honest with you. So because that cash flow is so negative and their profitability is just headed lower. So it's on the watch list for, okay, if things turn around, maybe subsidies are continued and the environment works out. This is a good horse because of the fact that it is historically one of the best run solar names out there. But I just think the environment, the technicals, all of it lines up where it's just too weak for me. So I would pass on it. I think there's much better opportunities in this market.
Okay, thank you.
No problem. Thanks for the call. Let's go talk to a live caller. Arias from San Diego wants to talk about annuities. How you doing, Arias?
Pretty good, Justin. Quick question for you.
Sure.
Your grandfather was not a big fan of annuities.
Very true.
And he gave his reasons why.
Mm-hmm.
And then when Steve Peasley came on board, may he rest in peace,
mm-hmm.
he wasn't a fan of annuities either. With his background in insurance, he went into deeper details of why.
Yep.
He wasn't a big fan of annuities. My question to you is there any time where you can use annuities as part of your financial portfolio? And if so, why? And if not, why?
Yeah, very simple. Fixed annuities are appropriate for some people that have very low risk tolerance and they want to create a guaranteed income stream that supplements them above Social Security, for example, and have that peace of mind that that income is going to be there no matter what. And that can be a place for it. But as a long-term growth vehicle, they're almost always a bad idea. Okay, so you're talking about fixed index annuity. So that's a big difference. You might hear fixed and you think, oh, it's a fixed annuity. No, fixed index annuity is different than a fixed annuity. Okay, so not a fixed indexed annuity, indexed to some, index, right? So S&P could be Russell 3000, could be Wilshire, whatever that is, right? So a straight up fixed annuity where it's, okay, I'm getting X payout guaranteed There's no growth. There's no downside. It's just straight up, I'm getting this payout. And that can be good for certain people, but it's very small slice. And usually when you're, and the reason those aren't really sold is because the person selling it, the salesperson and you have to watch out for this. I see this all the time. Oh, it's my advisor, financial advisor. No, if they work for an insurance company, they're a salesperson. And they usually don't push those because they don't earn a high commission on them. And so that's why most people don't get them. They get some sort of indexed annuity or variable annuity. And that's just, a poor use of capital, especially tax deferred. I see this all the time where they buy an annuity in an IRA, which is adding insult to injury. So yes, there are options, or there are situations where fixed annuities can make sense, but almost never a variable or indexed annuity.
Thank you. I appreciate it.
No problem. Thanks for the call. Now, I hope you've been telling your friends and family that you can find us over on our YouTube channel, and you can see my face, you can see my data that we're looking at when we're answering these questions, and we love the comments that come in over there as well. And let's answer one of those questions now. Adrian Vasquez says, I would like your thoughts on Brita Water Filters Company, Clorox. New study shows Americans drinking water has hazardous chemicals. Yeah, I mean, I'm a big fan of filtered water. I try to never drink tap water myself. But, I think your issue here is you're trying to play that by investing in a large company like Clorox that has a lot of different businesses. And Brita Water Filters is just one of them. Okay. And I'd have to go into my deeper research to find out what percentage, but I would imagine it's very small. Now, Clorox is, a consumer staple. It's obviously doing very well right now because consumer staples are doing well. But, business is a bit up and down. Last quarter, revenues were down 15%, earnings were down 28%. They're supposed to earn $7.19 this year after earning $6.17 last year. Obviously, 2021 was a bumper year for them in 2020 during COVID. And they're just climbing back to those levels. So I think I like the earnings trajectory generally. And I like the company generally, the profitability here. But I wouldn't buy it just for Brita Water Filters. That's not something that I think you want to pure play and find some smaller names that are in the water filtration business. I can't think of, is Waters one? I'm trying to remember. WAT? No, that's not it. There are ones out there that are more pure play on filtered water, and I think that's what I would go with. I would look for something like that as opposed to trying to play water as a small subsegment of Clorox. Even though I like Clorox, it's just not the way that I would play it. Thanks for the call.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates.
Hi, Justin and Luke. Can you please take a look at Airbus versus BAE Systems? I'm looking for European defense exposure. Thank you guys for what you do. Have a nice day. Thanks.
All right. Looking at Airbus versus, what was the other one? Take a look here. EAD Systems. Okay. There we go. Okay. So Airbus, one thing I like about Airbus, first off, is their main competitor is sucking wind and led by poor management. That's Boeing, right? And so Airbus just continues to take their market share. And then you have the defense side. Obviously, Europe is likely to spend more on defense due to geopolitical volatility, and there are some nice tailwinds there. Okay. Now, the other one, pull that up here. There we go. BAE Systems. Okay. This is a British defense company, and it's a bit more volatile here. And so I would probably go with Airbus. Historically, they just have more consistent profitability. I like that tailwind on the commercial side as well as the defense side. They have a good balance sheet. So if I'm picking one or the other, I'm definitely going with Airbus. Now on Fridays, we generally make time to fit another a rundown of some quick key benchmarks for the week. So let's do that now. The 2-year Treasury yield right at about 4% on the close of the week. Last week was at 4.2%. That's showing you that almost a full cut is now priced in to the markets over the next 2 years in just 1 week. That's what a sell-off in markets can do. That's what the economic data being weak will do. That's what the inflation data being relatively tame will do. And so that's what was priced into markets this week. Almost one extra rate cut. The 10-year Treasury yield, 4.24% at the close. That's down from 4.42 last week. So not quite as big as a drop on the 10-year, but pretty close. Gold, 28.43 an ounce. That was down, the first down week in a while. Last week it was at 2,941, and it's 2,843 this week. Silver, 31.03, down from 32.76 last week. And once again, modest sell-off, no issues from a technical perspective in the precious metal market. Oil, $70.09 per barrel. That is down 48 cents from last week. Okay. And then the national average for gasoline, regular gasoline, $3.11, down 5 cents from last week. Here in California, though, $4.79. We're still paying through the nose, also down 5 cents for the week. Now, for comparison, Kansas, gas is $2.81 a gallon. Now we've got time, so let's play another listener question.
Hi, Justin or Luke. Thank you for the show. Calling today about Vertiv, ticker VRT. I've had this on my watch list and it's pulled back. I'm waiting for a further pullback. Was just hoping to get some information on what you think is a good price to enter this position. Thank you very much. Have a good day. Bye.
All right, looking at Vertiv Holdings, and this is a company that benefited from the AI data center build out, and we know that trade is unwinding to a degree. The question is, at what point is it gone too far? Now, right now, it's down about 39% from its 52-week high. Historically, let me tell you kind of historic patterns. When you have these crazes around some sort of a narrative where names are drastically overpriced, overhyped, and then they come unwound, typically they drop anywhere from 60 to 80% from their high until capitulation happens. Now, the magnitude usually depends on really how strong the company is underneath the surface and how much hype was in it, right? So there's a lot of factors here. So while 39% is a lot, there's still a potential for more downside, especially if there's credence to the idea that, yes, companies are pulling back to some degree from their AI data center spending. Now, earnings expectations for this year continue to be strong, $3.59, but estimates for next year continue to come down, but still nice growth of 23%. But the P ratio is in the low 30s, and this company, pre-2023, never made a lot of money. Actually, they lost a lot of money in certain years. Like 2018, they lost $4 per share. So there's no guarantee that this name will stay in the relative valuation on $36 billion market cap. It's come a long way, right? Bottomed around $8 per share. Now it recently peaked at $155 per share. Now at 95. Now let's take a look at the technicals here. Just want to see where major support might come in. Just want to run some analysis, some simple technicals. Now there is some support here, right? $91 per share. It bounced off this level. But if it kind of chops here for a while, it probably goes to the next level, which is 75. And then big support would be right around $60 per share. That would be major support around $60 per share. We're at 95 now. That feels to me like the correct area to get in. That also is around the low in last August. Okay. So complete unwind of that final push higher is not unreasonable either. And it would put you, right, if it peaked out at 155, $60 would put you right around that, 60 to 70% drop. That's typical for these names. So though that's the area that I would think about picking up Vertiv VRT.
Stay informed and stay empowered by visiting investtalk.com today.
So let's go answer that listener question from our YouTube channel. And Adrian Vasquez says, with people striving to be healthier, what are your thoughts on FDP, Fresh Del Monte Produce? And yes, I think people have been striving to be healthier for a long time now. I actually think it's pretty interesting because obviously, historically, the Democrats have been ones that are very focused on, cleaning up health, cleaning up the food system, et cetera. And now RFK comes in on the right, historically a Democrat, and pushing the right towards healthier food. And so I think it's something the whole country is now on board with. So certainly eating fresher foods, less processed foods will be a trend. But it's been a trend, at least here in Southern California, right? I've been that way for a long time. And I think that's becoming more nationwide. But yes, FDP is Fresh Del Monte, about $1.5 billion market cap. So it's earned $2.70 this year, earned $2.42 last year. Those earned $2.96 next year. And so consistent growth, but not gangbusters growth. But if you go look underneath the hood, I like it. You have free cash flow about $130 million on a enterprise value of $1.6 billion. So you're talking about roughly an 8% free cash flow yield there. Return on equity is not amazing, around 7%, but solid. Dividend yield around 3%, with plenty of room for that to go up with a payout ratio only around 33%. They're not issuing shares, and I like the secular tailwinds here. And if you go look at the chart, there's definitely support here on FDP, which trading right around the 200-day moving average. Actually bounced off that, I believe, on earnings earlier this week and recovered nicely. And so I like this. This is an uptrend. I like the business. I like the secular tailwinds. So I'm going to give FDP a thumbs up. Now, lastly, let's touch a bit on how President Trump has kind of gone quiet on the stock market. And I think it's a telling sign. And, it's a shift in priorities. In 2016, he was tweeting all about the stock market throughout his first administration. In fact, in his first term, he tweeted about the stock market 156 times. 156 times through the 4 years. And since the election, he's only tweeted about it once. Okay. And it shows in the performance. From election day 2016 to inauguration day, through February of 2017, the SP was up 20%. So far, it's only up about 2.5%. And it's down, I think, about 5% now from its highs. So you're seeing a shift here. And what it seems to me is they're actually more focused, less on the stock market, more on the treasury market. It's part of what Doge is, right? Trying to clean up spending and waste and trying to get us more on a fiscally conservative path, which is detrimental to economic growth in the short term. That's just, once again, just math. It's not a political statement. And I think that's weighing on it. But it shows, once again, the priorities are not necessarily keeping equity prices higher. It's, okay, how do we sustain the debt, keep the debt bomb, shall we say, from unraveling over the next 4 years? And I think that's what they'll be focused on. And that may be at the detriment to the equity markets. Now, I do think at some point there is still a Trump put, meaning if things get bad enough, he doesn't want to probably see a 30, 40% slide in equities either, 10%, 15%, he's probably fine with. So I still think there's room for that, room for stimulus coming out of this administration to support equity markets, but it's clearly not top of mind, top of the list as it was before. You have a different cast of characters in this administration that is focused on other things. And equity markets clearly are not top of that list. So it's something I certainly take note of. And that's why I do think the knee-jerk reaction to, oh, this administration is going to be bullish for equities is a bit misguided based on the economic situation that we're in and the priorities of this administration. I'm Justin Klein. This completes another InvestTalk program, and we thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which they can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. And if you need help understanding the risk in your portfolio, how that relates to your risk tolerance level and your financial goals, I encourage you to head over to investtalk.com and click on the portfolio review button and fill that out. We will get back to you quickly and get you on my calendar. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.